On Point with Craig's Investment Partners.
The information provided here is general in nature. It's not financial advice. It doesn't take into account your financial situation, objectives, goals, or risk tolerance. All investments are subject to risks and none are guaranteed. So before you make any investment decisions, we recommend you contact an investment advisor. For more information about our services in that regard, you can go to our website, which is craigsip.com. Welcome to On Point. I'm Mark Lister, Investment Director at Craig's Investment Partners, and I'll be talking about a range of topics, including economics, portfolio strategy, investor education, and anything else that's happening out there in financial markets. Morning team, hope everyone is well. Let's take a look back at everything that happened across markets last week, then we will turn our attention to what we need to keep an eye on in the week ahead. Starting with global share markets, and it was a good week across most markets. We saw the US S&P 500 rise another 1% to fresh record highs. I've actually lost count of how many record highs we've seen this year, but it's been a fantastic year for US shares, which are up almost 28% more if you include dividends, and even more again if you include the 8% or thereabouts decline in the New Zealand dollar. In Kiwi dollar terms, the US S&P 500 is up a whopping 38% in 2024, so it's been a fantastic year for share investors. Japanese shares added 1.7% last week. Emerging market equities were up 2.5%. The FTSE 100 in the UK was up marginally, up about 0.3%, while European shares shrugged off all of that political turmoil that we're seeing in France and gained 2.5%. So most international markets up very strongly. It wasn't quite as buoyant closer to home. The Australian market, the ASX 200, slipped just slightly, down 0.3%, and the local market suffered its biggest weekly decline in almost 3 months. The NZX 50 was down 2% for the week. However, investors did have to digest a very large sell down of Auckland Airport shares. So what happened there was everyone sold their other shares to make room for Auckland Airport. So it's a bit of a technical sell-off, and I think that will blow over pretty quickly. The local market's still headed for its best year since 2020, up almost 9% year to date with a few weeks to go, and my suspicion is that that optimism will return, and after that sell down being behind us now, you will see a bit more positivity across the local market to end the year. US interest rates continue to slip ahead of next week's Federal Reserve meeting. The 10-year Treasury yield finished the week marginally lower, down to just below 4.2%. Markets see an 85% chance of another 0.25% rate cut from the Federal Reserve next week. That would take the upper bound of the Fed funds rate to a 2-year low of 4.5%, down from a peak of 5.5%. Looking back at some of the key releases, it was quite a busy week in the US in terms of economic releases. We saw the ISM indices for November, that stands for Institute of Supply Management. They provided mixed feedback on the state of the economy. The manufacturing ISM was better than expected, so it actually rose to a 5-month high of 48.4. It's still below that break-even level of 50, but it's certainly better than it has been. And the new orders component, which is quite a good leading indicator of what's coming, that was also quite solid. That rose more than hoped, and it hit an 8-month high. And the good news didn't stop there either. We saw the prices paid index come in well short of expectations. That's important because it's a sign of slowing inflation pressures. Turning to the services ISM, and this was a little bit softer than expected. It slipped to 52.1. People thought it would be stronger than that. However, it's still easily in expansionary territory, easily above that 50 break-even level, and it has been for 5 months in a row. In fact, it's been above 50 for all but 3 months of the past 4 years. So not too bad, the ISM indices. The big news last week in the US was the jobs report. This came out on Friday night, so we got these figures on Saturday morning here in New Zealand. It covered the month of November, and this was a really important one because the labour market is a real focal point ahead of that Federal Reserve meeting that takes place next week. It probably hit the sweet spot too because it was strong enough to allay any concerns of an economic slowdown, but it wasn't so strong that it would dissuade the Fed from reducing interest rates one more time before the end of the year. So very much not too hot, not too cold, right in that Goldilocks zone. We saw 227,000 new jobs created, which is a little bit ahead of expectations, but not super strong. It was certainly better than last month, which was heavily impacted by strikes and weather events. The unemployment rate increased slightly to 4.2%. It was 4.1% a month ago, although that did come on the back of a slightly higher participation rate. So it's nothing to get too concerned about. And the underemployment rate, which is a broader measure of labour market slack, also rose to 7.8%. Here at home, the key release came from the dairy sector, and this was some very good news for the New Zealand economy. The latest global dairy trade auction showed that prices rose another 1.2%. That was driven by a very strong gain of 4.1% from whole milk powder. Prices are now up 22.3% this year, and they're at the highest level since July 2022, so almost 2.5 years ago. And last week, Fonterra followed that up by increasing its milk price forecast for this season, the 2024-2025 season, again. So it increased it by another 50 cents, so it's now sitting in a range of $9.50 to $10.50. That means the midpoint is at $10. Now, that would be the highest of all time, and that would be the first time we've ever cracked double figures. The previous record was $9.30 from 2021-2022. So very, very good news for New Zealand Inc., good for the dairy sector, the agricultural sector, and very positive for all of those communities up and down the country that really do hinge on what's going on in that dairy space, that agricultural space. Fonterra noted that a recovery of demand from Greater China was one reason for the upgrade, and also that demand from Southeast Asia was remaining strong. Supply factors were also pushing prices higher, with lower production out of the US and Europe at a time when most of our dairy regions here in New Zealand have been increasing output. So very positive news there for the New Zealand economy. Looking ahead to this coming week, and the key release internationally on the economic front will be the latest US inflation figures. These are out on Wednesday. They will cover November, and this is the Consumer Price Index. It's one of the last releases that we'll see ahead of that all-important Federal Reserve meeting late next week. And the CPI has been a little bit stronger than expected these last few months. The annual change in the headline CPI has risen to a 3-month high of 2.6, and for November, markets expected to rise slightly further again to 2.7. The core CPI forecast to remain unchanged at 3.3%. So you're still in the twos for the headline, but it is creeping up. And that does tell us that while inflation has largely been tamed, the Federal Reserve can't take its eyes off those pricing pressures and those inflationary risks completely. So I think this will very much be in focus, because it's really that last data point that we need to see before we can firm up those expectations for what the Federal Reserve will do next week. While we're talking central banks, there are a couple of other meetings this week. There's 4 actually. You've got the Swiss National Bank, you've got the Bank of Canada, you've got the ECB, and you've got the RBA across the Tasman. The ECB in Europe will be in focus. They meet on Thursday, and markets do expect another 0.25% cut to finish the year. That would take the policy rate in Europe from 3.25 to 3%, and it will be the 4th cut of this cycle. They reached a high of 4%, which was the highest that we've seen since the euro came into being in the late 1990s. So they're expected to be at 3% by the end of this week, having been at 4% not so long ago. There's been some good progress on inflation in Europe. The annual headline inflation rate is sitting at 2.3%, core inflation at 2.7%, and as a result, markets expect more cuts from the ECB next year. The policy rate is expected to fall under 2% by the middle of 2025. So Thursday night this week, you should get a cut from the ECB, 25 basis points. Before that, we will hear from the Reserve Bank of Australia. Their announcement should come out at 4:30 p.m. on Tuesday, I think, and markets don't see any real chance for a change in policy settings. The Aussie CPI, the inflation rate, came in a little bit weaker than expected in the September quarter, although it's still sitting at 2.8%, which is a bit too high for comfort for the Reserve Bank of Australia. We've seen a bit more progress in the monthly inflation indicator in recent times. It's fallen to 2.1%, although although this measure has proved a little bit volatile in the past, and I think policymakers will want to see more evidence of moderating price pressures before they cut interest rates. So across the Tasman, you've got an OCR, or the equivalent at least, at a 13-year high of 4.35%, and a cut is not seen until February at the earliest, and even then it's looking a bit 50-50. So you've got to look out to April before you find the time when markets have some confidence that you will see a rate cut across the Tasman. On the local front, we'll get some further GDP partials. That stands for gross domestic product, so more pieces of the puzzle that will give us a feel for exactly where GDP will land for the September quarter. That is released late next week, so there are a few bits and pieces this week that will feed into that. That's expected to look a little bit better. It should be the strongest we've seen for about 18 months, one would think, the December quarter, as things do move into a more buoyant period. Next year is when we'll really see the economy lift itself out of recession, but the December quarter should look a little better than what we've seen over the last few quarters. We'll also get the latest housing market update from the Real Estate Institute, or at least I think we will. I suspect we might see this late in the week, maybe on Friday. If not, it will come early next week. But this will be interesting. This will be for November. Last month's figures continue to point to signs of improvement. Although the housing market is far from buoyant, you are seeing some green shoots. Nationwide sales volumes rose 10%. They were up 20% on the same month a year ago. The days to sell, which is a really important indicator of an improving market, that was lower in Auckland and across the rest of the country too. And the house price index nationally rose 0.4%, which is the second month in a row that we've seen an increase after a long string of declines. So prices are still well below that peak from 2021, more than 15% below those levels, but they have started to show just a few signs of improvement. So we might get that on Friday morning. If we don't, then it will probably be something that we'll see early next week. On the corporate front, it's pretty quiet. There's not much going on here in New Zealand, not much going on in Australia, although there are a couple of big releases internationally. Adobe will release its latest earnings report on Wednesday. That's in the US, so we'll get it on Thursday morning. And a day later, Thursday in the US, Friday in New Zealand, we will hear from Costco. So a couple of things to keep an eye on there. Right, that's another week down. Enjoy it, take care, and we will talk again soon. Thanks for listening.
For more insights, visit craigsip.com.